Building wealth isn't about chasing trends. It's about building a resilient strategy. In today's volatile markets, smart investors rely on strategic asset allocation to balance risk, optimize returns, and stay disciplined through every market cycle. In this video, we'll break down how to diversify across asset classes, manage risk exposure, and construct a portfolio designed to withstand uncertainty while capturing long-term growth opportunities. 1. Define clear financial objectives. The foundation of a resilient investment portfolio begins with crystal clear financial objectives. Without well-defined goals, any allocation is speculative at best. Objectives should be specific, measurable, and time-bound. For instance, an investor may aim to accumulate $2 million for retirement at age 65, fund a child's college education in 15 years, or generate a consistent annual income of $50,000. These targets influence every subsequent decision, from risk exposure to asset class selection. Clear objectives also help investors measure progress objectively, reducing the likelihood of making impulsive adjustments during periods of market volatility. In practice, defining financial goals allows investors to reverse engineer expected returns and required savings, providing a roadmap for disciplined wealth accumulation over decades. 2. Assess risk tolerance and risk capacity. Understanding risk is more nuanced than simply labeling oneself conservative or aggressive. Risk tolerance involves an investor's psychological comfort with market fluctuations, while risk capacity reflects their financial ability to endure losses without derailing life plans. For example, a young professional with stable income and long investment horizon may tolerate higher equity exposure because temporary market declines have minimal impact on their long-term objectives. Conversely, a retiree dependent on portfolio income may prioritize capital preservation, reducing equity exposure to avoid significant drawdowns. Strategic asset allocation involves quantifying these risks in terms of expected volatility, potential drawdowns, and sequence of returns risk, ensuring that the portfolio structure aligns with both mindset and financial reality. Ignoring this step often leads to panic selling during downturns or overexposure during market booms, undermining long-term performance. 3. Establish target asset class weights. Strategic asset allocation defines the percentage of capital allocated to each major asset class: equities, bonds, real assets, and alternatives. This structural design shapes the portfolio's risk-return profile. For instance, a growth-oriented investor may assign 70–80% of the portfolio to equities, while a conservative investor may limit equity exposure to 40%, balancing the remainder between bonds and real assets. These weights are informed by expected returns, volatility, correlations between asset classes, and long-term capital market assumptions. The target allocation is not static. It is a dynamic framework designed to meet objectives under varying market conditions. Properly calibrated asset weights are the core determinant of long-term portfolio performance, often outweighing the influence of individual security selection. 4. Diversify across geographies and sectors. Diversification is the principle that turns an ordinary portfolio into a resilient one. Spreading investments across geographies, sectors, and economic cycles, investors reduce the impact of idiosyncratic risk. Domestic equity exposure is important, but global allocation to developed and emerging markets mitigates country-specific risks, such as economic recessions, political instability, or currency fluctuations. Sector diversification balances cyclical industries like technology and consumer discretionary with defensive sectors like healthcare and utilities. Diversification also improves the risk-adjusted return profile, as asset classes often respond differently to macroeconomic events. For example, while equities may fall during a recession, government bonds and certain commodities often perform better, stabilizing overall portfolio returns. 5. Structure equity exposure. Intelligently, equities drive long-term growth but introduce volatility. Within equity allocation, investors must decide between large-cap, mid-cap, and small-cap exposure, as well as developed versus emerging markets. Factor-based strategies such as value, growth, quality, or momentum can also refine risk-return characteristics. Strategic structuring ensures the equity component contributes growth while maintaining controlled risk parameters. 6. Build a stabilizing fixed income core. Fixed income provides income generation and capital preservation. A strategic bond allocation may include government securities for safety and corporate bonds for yield enhancement. Duration management becomes critical in fluctuating interest rate environments. High-quality bonds often act as a hedge during equity market corrections, cushioning overall portfolio drawdowns. This stabilizing function is essential for resilience. 7. Incorporate inflation protection through real assets. Inflation erodes purchasing power over time. Portfolios overly concentrated in nominal bonds suffer in high inflation regimes. Real assets such as real estate investment trusts, REITs, infrastructure funds, and commodities provide partial inflation hedging. These assets often respond positively during inflationary cycles, enhancing portfolio durability under diverse macroeconomic conditions. 8. Implement systematic rebalancing. Over time, market movements cause allocation drift. If equities outperform, their weight increases, raising portfolio risk. Rebalancing restores target weights by trimming outperforming assets and adding to underperforming ones. This disciplined approach enforces risk control and captures mean reversion benefits. Without rebalancing, strategic allocation loses its structural integrity. 9. Develop a written investment policy statement, IPCs. An investment policy statement formalizes allocation targets, rebalancing frequency, liquidity guidelines, and performance benchmarks. It serves as a governance framework that prevents emotional decision-making during volatility. By documenting rules in advance, investors reduce behavioral bias and maintain consistency across market cycles. 10. Review and adjust periodically. Strategic asset allocation is long-term but not static. Life events, career changes, inheritance, retirement, necessitate allocation adjustments. Additionally, structural economic changes may alter long-term capital market assumptions. Periodic reviews ensure alignment between portfolio structure and evolving objectives. A resilient portfolio adapts methodically rather than reactively. In essence, strategic asset allocation is a disciplined framework built on objective analysis, diversification, and consistency. It prioritizes structural strength over short-term market timing, enabling investors to pursue sustainable wealth accumulation while managing downside risk effectively. A resilient portfolio isn't built overnight. It's built with strategy, patience, and discipline. By mastering asset allocation, you position yourself to navigate market volatility with confidence and clarity. If you found this breakdown valuable, make sure to like this video and subscribe to the channel for more in-depth insights on investing, wealth building, and financial strategy. Stay consistent, stay informed, and keep building smarter portfolios.